All right, guys, today we're going to talk a little bit about market structure and why it's so important. Market structure is the flow of the market. When you have these moves where, and I'm just using the daily chart on Bitcoin for an example here, when you have these moves where you can draw price going up, retracements, it looks like it goes higher, it pulls back again, price goes up again, down again, up again, etc. That's what we call market structure. It's the overall trend. And I'm more than confident that most of you that are watching this right now have heard the saying, the trend is your friend until it isn't anymore, essentially, right? And it's all based on market structure. So market structure is made up of a series of highs and lows, okay? So we have a series of higher highs and higher lows in an uptrend. Whereas in a downtrend, you have a series of lower lows and lower highs. Okay, so that's the difference. It's just upside down. Not only do you have these upwards trends and downwards trends, but you also have sideways trends. That's when all the memes come out. So we have these sideways trends, which is still technically market structure. It's just known as a range or a range-bound environment, right? So there's different forms of structure. You have uptrends, you have downtrends, you have sideways structure, also known as a range. Okay, and those are the three primary types of market structure that you will see going forward in this course. In fact, there are no other forms of market structure besides these forms of structure. There are different ways of looking at structure, e.g., primary structure, internal market structure, internal 2 structure, internal 3. Heck, you can go all the way up to internal 20 if you wanted to. We'll be talking more about these internal levels, and the more advanced stuff in a later lesson. But for today, we're going to keep things very basic. So how do these trends form and how does market structure work is the real question. So the way that structure is presented, as I mentioned, is in a series of up candles and down candles on the chart itself. There are indicators out there that can assist with this, marking in what we call a higher high, a higher low, lower lows, and lower highs. However, I cannot stress this enough. I highly recommend you avoid using any sort of indicator to assist in this manner because it's very difficult to program market structure properly. So in the above example here, we have an uptrend. In an uptrend, the job of every higher low, and this is what we call a higher low, okay? This is a higher low. If this is the previous low, this one is definitely higher. This is also a higher low because it's higher than the previous low. So in an uptrending environment, you have a series of higher highs and, of course, higher lows, right? The job of a low in an uptrend is to take out the high that created it, which would be this high. If it does so with the candle body close, then this low, or rather higher low, is now considered a protected low. Okay, we'll be getting into that more later on. So in this example, this low, we'll say that there was indeed a candle body close above this previous swing point, or higher high, if you will. So therefore, this became a PL, a protected low, PL for short, okay? As with this would also be a protected low because price closed above it. Pretty basic, right? So we have an uptrend. I know it looks fairly messy. We'll start over here in just a moment. We'll make this a little bit cleaner. But we have ourselves a basic uptrend. Now, the saying, the trend is your friend until it isn't anymore is a pretty nice saying because in reality, there is no such thing as an everlasting trend, okay? You will not trend up forever, especially if there's a reason to come down and transition that market structure from an uptrend to a downtrend. Perhaps price is coming into an area of resistance. Maybe this is a local uptrend on a lower time frame, and perhaps this may be higher time frame structure, a higher time frame structure, higher high. And once a higher high is put in, as you can see here, what happens to follow? You tend to retrace, right? Price tends to pull down. Why does it pull down? The reason why price retraces in an uptrend and why price retraces towards the upside to make a lower high in a downtrend is because price needs liquidity. It needs to take liquidity from stop losses from previous positions, e.g., the guys that say shorted right here and here, the guys that shorted right here and right here, those that have longed late to the party over here, up here, also known as breakout traders. In this example, they would have been taken out right here. So price needs to come back for their stop losses and or liquidations in order to continue a healthy trend, which is why it's not so efficient for price to aggressively push to one side for an extended period of time, because ultimately it's not sustainable, especially if these retracements, in this example I drew what I would deem to be a healthier retracement. We'll talk about that as time progresses, but for now, in this example, we'll say maybe this was like a 386 retracement. Right? Maybe this one is as well. We'll call that like a 386 retracement, just a basic Fibonacci level. Same thing here. Same thing here. Not quite a 0.5, but almost a 0.5 retracement. Use your imagination, right? So in this example, then I would say that that's a fair enough retracement. That price doesn't necessarily have to come down any lower. However, what if the retracements looked a little like this? Right? What if they weren't as significant? Well, in that regard, I would say, hey, you know, this is looking quite overextended. Price very well could come smacking down very soon because it's not retracing enough. It's not grabbing enough liquidity. So going back to market structure and leaving the liquidity for a later lesson, how do you draw market structure? It seems to be very easy just to take the path tool and kind of doodle what I just doodled out there. Anybody can do that. There are rules that I employ to determine market structure. But before I get into the rules, why is it so important? How can it be effective? Why do I need it? Right? There are many, many answers to these questions, but for starters, the reason why I would say market structure is very, very key in anybody's trading is because if you cannot identify the overall direction of a trend, whether it be short-term, mid-term, or long-term, how are you going to be able to trade with that? Because you certainly don't want to be on the other end of the table, right? You don't want to be trading against the trend. Trading against the trend is a surefire way to get wrecked. No question about it. If you don't know the overall trend, you should not be getting into a trade. So in terms of market structure, if I were to draw out this structure from September of 2020 up until current January of 21 on the Bitcoin chart, there's a few different rules that I employ, and I'm going to show you guys how I go about it. But before I do that, let's start up to about right here. We'll work it up from here. All right, so from this very, very bottom here, and I believe this was the COVID-19 dump, if we were to pull market structure from this low, kind of ignoring all this, we'll just start a new trend because we'll say that was a black swan event. So we'll start everything from right here. Price came up, price came down, price came up, it came down, up, down, up, down, up, down, up, down, up, down. That's kind of messy, isn't it, right? That's not how we should draw structure. Now, that is a form of structure. It's just not what I call primary market structure. Primary market structure is quite important. It's going to be your main structure from the beginning of a notable trend. So, for instance, because I can see in hindsight now that price broke bearish structure here, and we'll be talking about that, of course. But because I can see in hindsight that it broke bearishly here and then had a bullish transition, I feel the need to start my structure pull from here. Not only that, it was the first time in a while we had an aggressive dump, and it was a buyback that we never revisited again. So how do I draw the structure in from this low up until where we are now? Because you will be analyzing previous movements to get to where you are now when you're using structure. It's not only about the now, it's about the then and the now. So what we have here in front of us is a move that clearly went up. In terms of a measured move, we're talking 437 and some odd percent move, right? That's quite the move. So drawing my market structure out, there's a couple of rules that I follow. In order to have a higher low, okay, in order to have a higher low during an uptrend, there has to be, at any given point, 2 consecutive black candle body closes that trade lower than one another. Okay, this is very, very important. There has to be 2 black candle body closes. So in this example here, if I were to zoom in and I started my trend from this bottom, this is not an up and a down. It's not an up and down move because these are not 2 black candles in a row. Okay, and it can be at any point during the higher high to the higher lows creation. As long as I have 2 of them in a row, it is acceptable behavior for market structure. This is not a rule that you will likely find elsewhere. This is something that I keep very dear to me, that I decided to release in the course because I think it will help a lot of people with false moves. And statistically speaking, you end up with a much cleaner market structure pool employing this rule. So what we have here from the bottom, working our way up, is we have a higher high. Price came down with 2 black candles in a row. Even though they are kind of side by side, this candle on the right, it did close lower than the one on the left. They are 2 bearish colored candles in a row. Okay, they are 2 bearish colored candles in a row. So I can call that a higher low. But notice how I'm kind of pulling over to the right here. I'm not really drawing my market structure from the bottom of this black candle. And the reason for that is because the candle on the right, which is bullish, is the lowest point. I need to take the lowest point between a higher high and from when the high is touched again to deem a valid higher low. So as an example, if this is your high and you see something like this, and this happens to be the lowest point right here, between those 2 points where it was touched finally, I don't care if it's touched with a close or a wick, as long as it was touched, that's all that matters. So even if price wicks up to here and does not close above it, and this is what you see, technically speaking, it was touched. This previous high was touched. So what that tells me is that, wait, this is my point here, okay? I can't go a little bit lower, I can't go a little bit higher. This is the lowest point between here and here, okay? So this is my higher low. There has to be 2 bearish color candles in a row. In this example, that would be deemed acceptable. Non-acceptable behavior would be to have a bearish color candle, a bullish color candle. Let's say that's a bullish color candle, and then another bearish color candle. I cannot use that on the same time frame that I'm employing. I would have to then modify my time frame. Yes, it really does matter. Okay, there are reasons why this matters. We will be talking about that reason in a later version of this. So in saying that, this is how we determine a higher low. While we're on that topic, in a downtrend, it's the same rule that we're going to employ, except obviously it would be 2 opposite color candles in a row. So in that case, you need 2 bullish color candles in a row simultaneously in order to determine a lower high. Okay, same rules apply. So if I had green and red color candles, for instance, I would have a green candle here. As long as I have a green color candle here, even if the next color candle is black, or red rather, if we use green and red, even if this candle is red, it doesn't matter because at any point here during this low to lower highs creation, after the lower low was confirmed by touching it again, that tells me that, hey, okay, this is fine. I can absolutely draw this, and now this. Okay, that is a lower low, lower high, and lower low. Okay? So remember, during any downtrend or uptrend, the lower high or higher low is not confirmed until it is touched again. Okay? It's not confirmed until that previous higher high or previous lower low is touched again. Very, very important. I do see others trying to confirm a lower high before it's time to do so. I also see people get a little messed up because they start to look at structure as it's coming up here, say on a lower time frame, even before this is actually confirmed as a lower high, and they see a shift in structure on that lower time frame, and it messes them up. Well, because it's very easy to throw yourself off with structure, which is why this course is going to be very helpful. So looking at this current example, we're going to draw this in the proper way. We're going to take it very easy, very smoothly. We're not going to get into the intricate structure pulls. We're just going to take the primary market structure from this low. We'll be talking more about primary internal later, and we'll see what we get. So price came up and made a high. Price had 2 bearish colored candles in a row, but this is the lowest point between when it was touched again. So this is my current pull. Now, even though this is not a body close, okay, we'll be talking about more about that as I mentioned later on. It's not a body close. It's still notable to mark this in. We're still going to mark that in as a higher high. So price came down again. Do you have more than 2 black candles in a row during this pull from high to low? Yes, you do. But I can't call this a higher high and this a higher low. Why can't I? Because you have black, white, black. So that's a bearish candle, a bullish candle, and a black candle, a bearish candle. That is not 2 candles in a row that are bearish. So I had to skip that pull and I had to go to the next point. So the next highest point before a retracement is right here. And you, at some point during the higher lows creation, as we can see, if you pull this over to the right, this is when it was touched again. So you have to pick the lowest point between here and here. As you can see, there was 2 black candles in a row at some point during that higher lows confirmation. That's acceptable behavior. Okay, this is fine. So let's draw it in. So continuing on with the path, we have a higher low. We have a higher high. Now this is a tricky example. This is tricky because the first black colored candle, or first bearish colored candle, is actually the highest point. Okay, which isn't too unusual because we had one here, but the unusual part is everything was contained within here. Okay, notice how all this structure that I'm circling right now, which many people would have went higher high, higher low, and a higher high. Technically, that's not the way I want you guys to look at this. The reason why I don't want you to look at this one example, and you will see this in the future, I promise you that. But the reason why we're not going to call this a daily higher high and higher low is very, very simple, because it's almost like this is internal structure. It's internal because it's between here and here. Okay? So even though, yes, there is 1 and 2 black colored candles in a row, or bearish, whatever, in this example, they are contained within the original black candle. So it's not acceptable behavior. They cannot be contained within one another. Okay? That does not count. So if I see a situation like this, I would not use that swing point at all. I would skip past it and wait for a new higher high. If you went to a lower time frame, you would see this as a range, and then it broke up from said range. So if pulling this on, we have a higher high and what looks to be a very clean possible higher low. Okay, we're actually going to let this go live. So we have a higher high and then a higher low. All right, so when does it touch the high again? Well, it did right here. So because it touched the high again, we can now see that, oh, this is now the lowest point in between here and here. So again, we have a confirmed higher low. Let's draw it on further, shall we? We're going to watch price play out. Now notice something. We have 1 black candle here. We have a few white bullish candles, a black one, a few white ones, a black, a white, a black, and then we finally start to see a few different bearish color candles in a row once again. However, if I were to draw these guys in, technically they are not fully contained in. So the same example that we looked at before using this higher high, which what we thought was a higher high until we re-examined, I wouldn't say this rule technically applies here. Okay, I would not say it technically applies here. We'll see how this plays out before it touches the high again. Even if it had, if we stop it here, even if, say this had came down right here and it actually went a little bit lower that would have been acceptable behavior because it wasn't only contained within one black candle, okay? These candles have traded lower than one another. That still would have been fine. Over here, it's a little bit different, right? This is more of a well-pronounced move down, whereas this is kind of like sideways price action. It looks like a range. This doesn't necessarily say, hey, you know, this has to be one big range. I'm sure it is a range, but it's still a notable retracement, whereas this was not. You had that one black candle on the high, and then the next point was essentially, you know, within that one candle. Technically, you're not within that one candle the entire time here, okay? You're not. You broke down. At first you were, but then you eventually broke down. So that is fine. So let's draw it down. But by starting to draw this down, I'm not going to forget that, hey, wait a minute now. And that was actually manipulated, but hey, wait a minute now. By drawing this down, I have to realize that this is not a confirmed lower low until this high is touched again. Price could still go substantially lower. In fact, it could retrace all the way down to this point here and still maintain bullish market structure. So I have to be aware of that whenever I'm doing this, right? So let's see what happens. Let's pull it a little bit further. Let's see when we touch the next higher high. Does price come back to this higher high? What's the lowest point between here and now here? Well, the lowest point would have been right here. So this would have been the higher low. And then price made a higher high. Okay, now there was not two bearish candles in a row, so we would have pulled it up to here. Okay, no worries. And then, of course, this is not a higher high and a higher low. At least it isn't on the daily time frame. Could it be on a lower time frame? Absolutely. Shall we investigate? Why not? Let's see let's see what this looks like from here to here. Even though it's not valid on the daily, what could this look like on, say, a 4-hour time frame? So on the 4-hour time frame, you had one black candle with a range in between the candles. So this would not be a higher high and a higher low, despite there being 1 and 2 black candles in a row. I would not use that. What about the 2-hour? You're probably going to end up with the same result, regardless of time frames here, because you had that purge of liquidity. Okay, this is where you could start a new structure pull, perhaps, instead of saying, oh, this has to be a higher high and a higher low. So in this example, we'll go back to the daily time frame and follow it up a little bit further and see what happens. And I want to show you guys what happens when price gets quite aggressive, right? So we'll look at that. In this example, you can pull it up higher and say, you know what? This hasn't had 2 notable candles in a row that were bearish until now. So I'm not going to use these points. I'm not going to use that point. I'm going to use this guy because we have 1, 2, and we're going to draw that horizontal line in. We're going to see if there was a transition in structure made on Bitcoin's behalf. So many people at this point in time, because they don't quite understand these rules and they don't quite understand the use of primary structure, etc., they would say, oh, wow, this just broke bearishly. But the reality is, despite there looking like a bearish structure shift here, the reality of the matter is, technically speaking, it's not. That's not a true bearish shift because the overall trend is pointing up. Okay, the overall trend is absolutely bullish. So what this tells me is that this is my protected low. This low made a significant break past the high that created it, which was this high. By doing so, we have a protected level, a protected low, if you will. Okay, so it is a significant zone. That is a protected low. Now you will have structure in between. So where's the next higher low? Right here, the lowest point between here and here. So this is how we determine how to pull market structure points. You're going to use the same rules regardless of whether or not you're pulling primary market structure, internal market structure, various levels of internal structure. It doesn't matter. These are the rules that you must obey if you want to succeed with your market structure pulls. If you want to have high confirmations, if you want to have high probability trades,